Okay, financial reporting. There are 5 financial statements that every investor and creditor wants to see, and every company has to prepare. One is the statement of income. The other one is statement of changes in equity. The next one is statement of financial position. Fourth one is statement of cash flow, and notes to financial statement is the very, very last one. Let's go one after another to see what's each about. So first one is statement of income. Every company or every user wants to see what's the company income. Is the company generating sales enough to cover the expenses? So what we're going to see on the statement of income, we're going to see sales, income, and after that expenses, expenses, expenses. Bottom line will be net income. At the very, very, very end, you may have earnings per share, just to have some ideas on the shareholders, how much of the net income of the company belongs to every share that they own. So what you have to take from here, this equation, how you calculating net income. Net income is revenue minus expenses. Once we find the net income, then we're gonna want to see what's the shareholder's position at this point. So the shareholder position is gonna have 2 elements. One will be the share capital, how much the shareholders invested in the company, and the second one will be retained earnings. We're going to see a little bit later what the retained earnings is. The third statement is statement of financial position, also known as a balance sheet. The balance sheet is going to tell you, once you make the income from the revenue minus expenses, once you generate that income, once you show how much belongs to the owners, where actually the money are. Are they an asset? Do you have any liabilities? And shareholders, we're going to get it from the statement of changes in equity. So, statement of financial position is going to tell you again assets, how many assets you have, what's the company liability. Those are the money that, or those are the resources that the company owns to the creditors, and how much of those assets belongs to the shareholders. In other words, when we deduct from assets the liability, that's going to show you that what's done is the net worth of the shareholders. We're going to have liquidity. Liquidity is how fast we can pay our current liabilities with the current assets. Current assets and current liability, as I show you in the class, that represents our working capital. How fast we can pay our assets shows us how liquid the company is. Assets. Assets are resources which are controlled by the company or the entity or corporation. It's expected to generate future benefits, economic benefits, and already happen, means that company already have control over those assets. Examples will be cash, short-term investments, accounts receivables, inventory, prepaid expenses, property, plant, and equipment, which we're going to talk more next time, in next lecture, on next Friday, right of use, intangible assets, goodwill. Characteristics, what's the liability? In order to define the liability, I believe I show you, we have to have a timeline. Once we have the timeline, we can define what the liability is. The liability is a present obligation. Today, I owe money because I did something in the past. for which I have to pay in the future. Again, the liability has presence of all the three perspectives of time: present, future, and past. Present is the present obligation, which has to be settled in the future for the event that already happened in the past. If you have settled that event with the economic resources at the time when the event happened, there would be no liability. What's the example of the liability? We're going to have bank loans, accounts payable, deferred revenue, notes payable, dividend payable, accrual liability, tax payable, long-term debt, lease, deferred income taxes. Those are examples of liability. Once we establish what the asset is and what the liability is, then we're going to the next point. What's the equity? Well, equity simply is asset minus liability. Equity, shareholders' equity, represents asset minus liability. Once we have the assets and deduct the liability, whatever left, well, that belongs to the shareholders. That's the equity. Also is called net assets. Why is net? Because we have one big amount of assets and then deducting something to get the net. As we said before, has two components here: share capital and retained earnings. Share capital represents what was contributed by the shareholders and how many shares were issued by the company for the contribution of the shareholders. Usually the amount that is staying on the share capital is the amount that the investors paid originally for the shares. The current market value of the shares, that's a different story. That can show you what's the value of that share at that time, but that has nothing to do with the share capital. Share capital represents the original amount paid by the investors for the shares that was issued when they purchased the shares. Next component here, as we have now the share capital, we already know what the share capital is. Let's see what the retained earning is. Retained earning is the earnings which are left in the company and hasn't been distributed yet as a dividend or used for other purposes of the company. So, how can we find the retained earnings? The retained earnings again will be always the net income minus the dividend. If the company opened today and company starts operations, they start generating income, but their beginning balance of the retained earnings will be zero because they just started. There's no previous history, there's no previous income. They started. So once they start generating income, retained earnings is going to start building up. What will be the retained earnings next year? Will be the retained earnings from the first year of operation plus the net income which were kept in the company in the current period minus any dividend paid to the shareholders. So do you make the difference between the net income and retained earnings? I want you to be careful here and I want you to clearly realize this. The other thing that I want to tell you is if I'm start stressing on something during the lecture or during the slides or anything, that means that thing's gonna happen. Either on the quiz, either on the assignment, anywhere. So pay attention what I'm saying and pay attention when I start stressing on something. So again, the difference between income and retained earning is net income is simply revenue minus expenses, where the retained earnings, as you can see here, including the net income, plus the retained earnings from the previous period, minus the dividend. So in order to calculate the retained earnings, first you have to calculate the net income for the year. Then you have to add the net income from the previous year or the opening balance and deduct the dividend that has been declared during the year. So net income will be the simple calculation, income, revenue minus expenses, where the retained earnings, it will be a little bit more complex calculation, which also includes calculation of the net income. Be careful what you have to do. Next statement is statement of the cash flow, which has 3 sections. One section shows the cash flow that the company are able to generate from the operating activities and operating activities only, which is the main purpose why the company exists. Second section of the statement of the cash flow will be for the any cash coming and going for the investing activities. If the company has too much cash, the company can invest, or if you want the company to invest in their own existence for the future, company can purchase long-term assets. Obviously, company can sell those investments, can sell the assets, that will be the inflow. The last section on the cash flow statement is the cash flow from financing activity. Financing activity will simply represent from where the company getting cash. Is it from the investor? Is it from the creditors? And for where the company pays its cash? Is it to settle the loans that already borrow from the creditors or paying dividend to the investors? The last piece of the 5 elements of the financial statements is the notes to financial statements. Notes to financial statements is the detailed explanation of every single element of the financial statements, starting with the statement of the income, which shows what's the sales, what's the purpose of sales, expenses, then going to the statement of shareholders' equity, shows you what's the shareholders' equity, from where that comes, how many shares are issued, where the retaining earning come from, how was calculated, and keep going through the balance sheet and for the statement of the cash flow, and explains everything in very close details. So you can have understanding of the entire company policy and how they measure the assets and how they're recording the assets. That probably will be the most important statement. However, this is the statement that the users of financial statements better read. That concludes the chapter 1. Now I can flip and move to chapter 2. Just give me a second. And I'm going to flip to chapter 2, and we're going to start working on our chapter 2. In chapter 2, we're going to start doing transactions. And we're going to see what's the effect on all those statements that I just mentioned. What's the effect on the income statement? What's the effect on the statement of the equity? What's the statement of the financial position? What's the effect on the cash flow statement? What's the effect on the notes? Before we do that, we have to set up some rules and standards. For accounting, we're using set of standards based on the nature of the company, based on what kind of company. Is it public? Is it private? Is it corporate? I mean, that doesn't mean it's a corporation or proprietorship. They're all using the same standards, but based on is it public or private, there are 2 available standards. If there's a publicly traded company. They have to use International Financial Reporting Standards. And all the other companies can use accounting standards for the private enterprises. Objective is to produce financial reports which are useful for the users, financial statements which are investors and creditors. Canadian Accounting Standard Board is the one who is responsible for the standards which are used in Canadian companies. So they're telling which company which standard should use. And international financial reporting standards are responsible for the international accounting, and those are created by International Accounting Standard Board. All the standards have framework, means that they have a foundation on which that standards are prepared. They have objectives and they have concepts. Again, two available set of standards. One standard is International Financial Reporting Standards for the publicly traded company, and one standard for the accounting standard for the private enterprises, which are not publicly traded. Why do we need those conceptual framework? To help the company to develop financial reporting standards first. Second is to assist the preparers of the financial statements to determine which account is affected. And the last thing is to assist the users to interpret the financial statements. So we're having three users: organization to develop the financial standards, accountants help the accountants to prepare the financial reports, and help the students to interpret those financial reports. We have two types of characteristics. One's are fundamental characteristics. The other one are enhancing characteristics. I'm not going to spend too much time in the details. If you are interested, you can check the International Financial Reporting Standard Conceptual Framework, which is very good, very useful reading, but you might find it at this level very boring. But anyway, on the fundamental qualitative characteristics, there are two types of characteristics. One is to be relevant, the other one to be faithful. In order something to be relevant, it has to be predictable. The value has to be confirmed, and materiality has to exist. Materiality is the level of the mistake which is not going to change user's opinion. Faithful presentation means the reports has to be complete. There's no omission of any information. Everything is there. They're neutral. They don't favorizing one versus another. You're not showing only the good things, you're showing everything. So that means the information is neutral. And the last one is to be free of error. Those are the fundamental characteristics. What's going to make the financial statements even better is the enhancing characteristics, which are help you to compare financial statements of two companies. Information is verified by the third party, auditors or reviewers. The information is presented on time, so it can be valuable for the user's decisions. And financial statements are prepared on the understandable manner, so user with sufficient information and understanding of financial statements can interpret that information and make intelligent decisions. However, in order to achieve all those characteristics, you have to keep in mind on what cost. And you always have to remember cost has to be less than the benefits. Or the other side, the benefits has to be more than the cost. So there's some other assumptions. One assumption is that company is not going to close anytime soon. Going concern is related to the assumptions that company will continue operating for the foreseeable future, which is essential for the company and for the users. Because if you know that the company closing next year, then you're going to use different approach to prepare the financial statements. So technically, all the companies which preparing their financial statements, all the financial statements are prepared on the basis that the company is going to continue its operation for the foreseeable future. Now we're going to the two type of accountings: cash accounting versus accrual accounting. Cash accounting is very interesting, and the cash accounting is basically individual accounting. Every individual prepare its own accounting records on the cash basis. What that means? Every time when you receive the cash, you record the transaction, and every time when you pay the cash, you record the transactions. With the company using different approach. What's that approach? The approach is they ignore the payment and receivable of the cash. So what they focus on? They focus on the nature of transaction rather than realization. So every time when the transaction happen, when the event happen, company recording the event. They're not waiting for the realization, means that exchange of cash. Example will be once the company provides a service to the client, they're recording the revenue, not when the cash is received by the client. Sometimes take time for the client to pay the cash, but company record the revenue. Why? Because the revenue has been earned. The other thing is when the company is selling let's say we're a merchandising company with selling merchandising inventory. Every time when the sales is complete, means that the item which is subject to the sale is moved hands from our hands to the customer. Sales is complete. When we transfer all the legal rights to that asset and all the risk to that asset to the client, sale is complete. Regardless whether we receive cash or not. Same thing with the expenses. Once we use the resources, regardless if we pay or not, we're recording the expense. We're going to see a little bit later how this works. So the revenue recognition. In the International Financial Reporting Standards, there's a 5-step process to determine was the revenue earned by the company or corporation or not. When the accounting standard for the private enterprises, then it's only 3 steps. That's why it makes accounting standard for the private enterprises easy to use, and it's used by the most company which are not mostly for the company which are not traded on the foreign stock exchange. The general thing that I want you to remember is revenue is recognized when the service is provided or when the goods are delivered to the customer, not when the cash is paid by the customer. So now let's see something interesting here. Accounting equation. I'm going to delete this one because you don't need this one at the beginning. Then we're going to start talking about this. Accounting equation. It's very important when we start now recording the transactions to keep this accounting equation in balance. Means assets are always equal to liability plus shareholders' equity. So from this formula, as you can see, and as you saw before, we can get so many interesting things. First, what we can say, our capital is the assets. Assets are the one who's going to help us to generate revenue. not the liability, not the shareholders' equity, assets. The question is from where the assets came from. And you have only two options. Either you get somebody to invest, either you have to borrow. So you have investors and creditors. There's nobody else. So if somebody asks you, what's the capital structure of your company, then simply you have to explain from where did you get your capital. Means if your capital as a percentage, if the capital is, well, capital is always 100%. No questions about it. Assets are always 100%. Now the question is, if on one side of the equation you have 100%, obviously on the other side of the equation you also have 100%. But now that 100% comes from two things, from the liability shareholders' equity. So the question is, how much is the percentage of the liability? How much comes from the creditors? And how much of that percentage comes from the investors? So for that reason, if you're only investing in your company, that means you're not borrowing. But if you borrow 20%, how much left for the equity now? Can I have 20% liability, 100% equity? What do you think? So now I have once I start getting money from the creditors, my equity goes down in order to keep the equation in balance. Make sense?
Yes, Professor.
So how can we get the liabilities? Well, liability we can simply get it. Since this is a formula, we can simply say asset minus shareholders' equity is going to give you the liability. But usually we're not doing that. But what we're doing is we're deducting from the assets minus liability, and we're saying that this is equal to the equity. In other words, that will be our net assets. In other words, that will represent the shareholder interest in the company or in the assets. So once we get the total assets and deduct the liability again, it's going to show us our shareholders' equity or how much is our net assets. That's one thing. The other thing that we need to calculate is the retained earnings. Again, retained earnings, in order to calculate the retained earnings, we need first to calculate the net income. How are we going to calculate the net income? Revenue minus expenses. And that's it. For retained earnings, we need the beginning balance of the retained earnings, net income from the period, and any dividend declared. So the net income is going to increase the retained earnings. So if we start, let's say that's our first year of operation, our retained earnings is 0. No questions about it. If we generate net income $100, our retained earnings become $100. If we pay $40 dividend, our ending retained earnings will be 60. Next year, we're starting now with 60, which coming from the previous year. Let's say we generate again $100 income. Now we have 160 available. If the company decides to declare $10 dividend, our retained earnings is going to be 150 at the end of the year. Next year, we keep going. From the previous year comes 150. Then we say checking the net income minus the dividend, ending retained earnings, and keep going, keep going. Make sense? Please know how to calculate net income. It's important. And how to calculate retained earnings. So once we know how that we have to keep the accounting equation in balance, once we know that how to calculate the retained earnings, and once we know how to calculate the net income, we can start working on our question today, for which I want you to use the template, which I show you on the right space. So on the template, you're going to see that we have assets, assets, assets. Then we have liability, and then we have shareholders' equity. And there is a one section which is called revenue, expenses, dividends. From that section is we're gonna get the retained earnings. So in the retained earnings, we're gonna keep separate the revenue, keep separate the expenses to generate the net income, and we're gonna see the dividend declared. So every time when we're generating the revenue, we're gonna show it as a positive amount. Every time when we're generating expenses, we're gonna show it as a negative amount. More expenses, more negative. That will reduce the income. If we have the revenue, that's gonna increase the income. So for the assets, we're gonna show cash, accounts receivable, inventory, prepaid insurance, equipment, land. For the liability, we're going to show accounts payable, interest payable, bank loans payable. Common shares, retained earnings will be the section for the shareholders' equity. And that retained earnings is going to come from the revenue expenses, which is going to show net income less the dividend declared. So again, revenue always going to increase the retained earnings or the shareholders' equity. Expenses always going to decrease the retained earnings or the shareholders' equity. Dividend declared, same thing. It's going to reduce the retained earnings or the shareholders' equity. So the only thing that helps the shareholders here is the revenue. All the other two components, expenses and declared dividends, going to reduce the shareholders' equity. So for the transactions, every transaction has to have effect on at least two accounts. Can we affect more than two accounts? Yes, it can. Equation always has to be in balance, means asset always has to be equal to the liability shareholders' equity. And retained earnings again are affected only and only by revenue, expenses, and dividend declared. So let's start with transactions in this company. Company is simple company, which start corporation on January 1st, 2024. The first transaction that the company did is the shareholders invest $250,000 cash and the company give them shares. So what we have to do? We have to start doing our accounting work. How can we do that? Again, before you do that, what I want from you is to go to the bright space. Download this slide template, which is sitting on week 1. Once you go to week 1, scroll down to learning material. At the very bottom, there's a slides template. Download this template. And once you download the template, I'm going to show you what you're supposed to see. Just give me a second. Once you open it, you should be able to see this. Can you see it?
Yes, sir.
Yes, sir. It's
Okay.
visible.
Okay. Do you have it in your screen? I
Yeah.
want you to be open on your screen so we can start working together. Whatever I'm doing on my screen, the same thing I want you to do on your screen. So let's go with the first event in this company or first transaction. The shareholder invest in the company $250,000 cash, and the company issued 10,000 common shares. As you can see here, what we have to do is for all those transactions, we have to put them in the right column, whatever we think it is. We have assets, we have liabilities, we have shareholders' equity. Shareholders' equity has two sections, common stocks and retained earnings. Retained earnings comes again from the income less the dividend. In order to get the income, we need the revenue and expenses. And after that, we're going to deduct the dividend. So every time when we have the revenue, that's going to increase the retained earnings. And every time when we have the expenses, that's going to reduce the retained earnings. And dividend also reducing the retained earnings. The last column that you see, that's a check. What's that check for? That check is to keep the accounting equation in balance. What that means is the asset always have to be equal to liabilities plus shareholders' equity. If we're not in balance, there will be amount here. So if we're in balance, we should be zero. That's our checkpoint. The other thing that one thing that I want you to do before we start is go here somewhere. And what I want you to do is insert something like this. So to be like this. And here will be our totals. That's what I want you to do. So now I'm going to flip and I'm going to make everything done. And those numbers also going to be a little bit smaller so it can fit and we don't have to adjust it all the time. Like this. And at the end of the once we're doing all the transactions, we're going to get the total. Or if you want to get the totals, you can just easily come and say, and that's going to give you the total, but that's, no, leave it. We're going to do this later. Once we start doing transactions, we're going to come and calculate the totals. Leave it for now. So let's start with the first one. First one again, shareholder or investor invest $250,000 cash, and the company gave him 10,000 common shares. So what the company get?
Cash,
Cash. How much cash the company get?
250,000.
Let's put it then. $250,000 cash. Actually, that's too small. Let's make it 12. Let's see if the 12 is gonna save me. No, it's too big. Let's go with 11. Still too big. I guess it's 10 will be the last. So let's stay with that. $250,000 company the shareholder, the investor invested in the company, and that was cash. Can you see it on my screen?
Yes.
All right then. So the company get $250 cash. Is there any accounts receivables? Do we have to get money from the clients?
No.
No.
Inventory?
No.
No.
Prepaid insurance?
No.
No. Equipment?
No.
No. Land?
No.
No. Do we have to pay to somebody?
Not yet. No.
Not yet. Did we have to pay interest?
No.
Bank loan? No.
No.
What do we issue? We issue common shares. Where should they put those common shares now? The one that they issue. Is it
Income.
revenue?
It should be revenue.
Did they sell something?
No.
No.
Dividends.
No revenue. Is it expense?
No.
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 Is it dividend?
No.
No. So then what is it?
Common stock.
Common stock, which is contributed. Contribution from the shareholder, correct? So 250 is gonna come here. Are we in balance?
Yes.
Yes, we are. Excellent. You did your first transaction. For some of you, that might be the first transaction in your life. Let's do another one. Okay, let's see now. Let's go back to the slides and see what's happened in the slides. So again, shareholders invested $250,000 cash. We increased the cash with 250, and we increased the shareholders' equity, common shares, with $250,000. Second transaction. Company borrow $100,000 from the bank. Let's see what we're gonna do now. So the company decide to raise additional financing, and they borrow $100,000 from the bank. Now the bank asks the loan is for 3 years, and the company has to pay annual interest of 6%. Interest is payable. We have to pay the interest every 3 months. So what the company get?
Liability.
But no, tell me what the company get.
Cash.
Cash.
Money, cash.
How much cash the company get?
10,000.
That's 100.
Oh, sorry, 100.
100,000. Let's get 100,000. $100,000 company get. Nothing else, right? No accounts receivable, no inventory, no prepaid insurance, no equipment, no land. Is this
Bank
accounts
loan.
payable? No, it's not.
Yes.
It's a
No.
bank loan payable.
It's a bank loan, right? It's not interest payable, it's a bank loan
We have
payable.
to pay interest, bank
Right.
loan payable.
So let's put it. Let's increase that payable. Are we in balance?
Yes.
Well, congratulations. You did your second transaction. Let's do another one. Sorry? Okay, let's go do now another transaction. Let's see what's the next thing that the company did. Now the company needs a place to operate. And they pay $1,100 cash to rent a space. Let's see how we're gonna deal with this. So company rented a retail location, paying $1,100 rent. What will be the rent for us? Is it gonna be asset
Liability.
or liability or expense? What is gonna be?
Expenses.
Expenses.
Right?
It will be expenses.
Expenses. So we have to pay How much cash we gonna pay?
401.
So what's gonna
1,000.
happen with our cash? Gonna go up or it's gonna go down?
It's going to go down.
Go down.
So let's go down. Let's go with our cash. 1,100. Going down. Nothing else moving, right? Nothing
No.
else.
Yeah.
And we pay in cash, so that's not payable. We just pay cash, so that's not payable. None of those payables. It's not common stocks.
It's expenses.
It's expenses. So our expenses gonna increase with 1,100. Are we in balance?
Yes, we are.
Yes, we are. So now let's see at this point, if somebody asks you, hold on a second, how much cash do we have? What we gonna say,
We have
We will
350.
lost.
right? What can we do is just make the
We'll
calculation now.
we'll add 1 and 2 and minus the third transaction.
Right. So I'm gonna get all those together, do the calculation, and we're gonna see how much cash I actually have. I have $348,000. $348,900. And what I'm gonna do, I'm just gonna drag this formula all the way across to show me all my calculations, right? What's the objective here? Objective is my checkpoint to be at 0, right?
Yes.
Because if I'm not at 0,
You're not in balance.
I'm not in balance. So now I have assets, right? How much assets I have? I have $348,900 cash in the bank account. From where those assets came from? $100,000 came from the bank. I borrow money from the bank.
Yes.
$250,000 the investor, the owner invested, and I pay expenses of $101,000, which gonna reduce the owner's investment. Make sense?
Yes.
So right now with this money, what I can do, I can pay my loan back right away, and the rest of the money belongs to the shareholder. Let's do another transaction. Next transaction. Now we start purchasing equipment. Why? Because we need to start operations. And how we gonna purchase, how we gonna pay for that equipment? We're gonna pay for that equipment cash.
Yes.
Do we have $65,000 cash?
We do.
Yes,
Yes,
we do.
we have.
Let's go for it then. Let's start spending cash. So what we're gonna do? We're gonna get the equipment, and our equipment's gonna go up with $65,000.
65,000.
What's gonna go down?
Our cash is going to go down with 65.
$65 gonna go, cash gonna go down. Is this gonna be affecting in any way the liability side?
No.
No.
No. Yeah.
No. Is it gonna affect the equity side?
No.
No. Revenue,
No.
dividend, nothing.
No.
Are we in balance?
Yes.
Yes, we are. So let's stop for a second and think, what happened here? We converted one asset into another asset.
Yes.
Make sense?
It does.
Yes, Professor.
So what happened is, I had cash, I don't have equipment. But now I have equipment, but I don't have the cash. That's all that happened. Okay, let's do another transaction. Let's see what's the next one. Now we purchase, once we bought that equipment, we want to purchase insurance. And we purchase 1 year insurance for 1,800. And since this is insurance company, the insurance company always want cash, so we have to pay them cash.
Yes.
So let's go and pay this insurance company. Now, what's the tricky part here? The only tricky part here is today is January 1st. Make sense?
Mm-hmm.
When this happened is January 1st. On January 1st, we bought that equipment. And on January 1st, we purchased the insurance to cover the new equipment for 1 year. On January 1st, how much of the insurance we use?
1 month.
We haven't
1,800.
used it as yet.
Sorry?
We have not used
We haven't used anything. Why? Because
because
the month
it's
hasn't
purchased on
started
the
yet.
same day.
Right.
Yes.
The month hasn't started yet. So, insurance generally, it should be expense, correct?
Yes.
But the question is, have we used it?
No,
No. So, is it expense for us?
not yet.
Not yet. When it's going to be expense?
When we start using it, so
Or
Yes.
when the time pass? Right? If 1 year pass, what that means? We use the entire insurance.
yes,
If 1 month pass, what that means?
1/12.
1/12 of the insurance pass. Make sense?
Yes,
So when we can show our expense for the insurance, if we have to record it every month? At the beginning of the month or at the end of the month?
End of the
end
month.
of
At the end of the month. So what we have to wait? We have to wait until the end of the
Till
month.
yeah.
Make sense? So now, but now we are January 1st and we have to do transaction. We have to record. We spent $1,800 cash. So what's happened with our
Yeah.
cash? Going up or going down?
Going down.
Going down. Let's go.
Going down.
1,800. We already said this is not expense. Expense is zero.
Mhm.
No revenue here,
That's
not
repair.
commission. So what is going to be?
prepaid insurance.
Repair
Prepaid.
insurance.
Prepaid insurance going to go up with 1,800.
And with assets,
Make sense? And
Yes.
now we are in balance. Nothing else changes. Everything else is zero. Correct?
Correct.
Excellent. Is it getting interesting now or still difficult?
Interesting.
How about the rest of the people?
Kind of.
Kind of?
interesting.
Still in. Yeah.
So interesting.
Okay, let's go. Let's do another one. If it's getting interesting, let's do another one. Number 6. Now the company purchased land and pay cash at $180,000. So what we have to check first?
If we have
cash or not.
$180,000,
Do we
Cash.
have
Yeah.
$180,000? Do we have?
Yeah.
we do.
We do.
We do have.
We have $282,000.
Yes.
Yes.
Right?
Yes.
Can we purchase that land for $180,000 cash? Yes.
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 So what's
Yes.
going to happen?
Cash will decrease.
It's mine,
Minus
In cash.
180,000.
and land will increase by 180.
All right. Liability?
No,
Equity?
No.
No.
Are we in
No,
balance?
yes.
Yes. Perfect. So now let's see what we have. See how many things now we have.
Yeah.
Now start getting interesting. Now we have less cash, but we paid for the insurance, which you haven't used yet. We have
Mhm.
equipment and we have a
We
land.
have land.
So many things now we start having. All right, let's do another one. looks like a monopoly, isn't it?
Yes.
Okay. Let's go with another one now. Sorry. Where we are? Yeah. So now the company purchased inventory. Now we want to start selling something, right? We want to generate some revenue. How are we going to generate revenue? When we purchase something and then we're selling it. And we purchase inventory, $23,000, but on account.
They have not paid it still.
Right, they haven't paid. So let's see what that means on account. What they get first?
Inventory.
Inventory.
So it's a plus.
Inventory will be
Going up with 23,000. Did we pay cash?
no.
No.
No. Do
So
we
accounts
have to
payable.
do we have to pay cash?
no.
No. Did we pay cash?
No, we did
No,
not.
No,
we
we
didn't
didn't.
pay.
Do we have to pay cash?
No, we do not.
No.
Not
We'll
yet.
be paying in future.
In the future, but technically we have to pay at some point,
Yeah,
right?
accounts payable.
So that will be accounts payable. 23,000. That's not interest payable, not bank loan, no common shares, no revenue, no expenses, no dividend. Are we in balance?
Yes.
Yes. So what's happened now? Inventory goes up and liability goes up. Why? Because we haven't paid.
Yes.
Do you understand the idea on account?
Yes. What it means is you haven't paid fully or you haven't paid in cash for it now, but you are liable to pay in on a future date.
Yeah.
Correct. Everybody understand that?
Yes.
And everybody
Because it
understand the term on account? So the other way that you can think of this is if I don't know if you've been in here on the bar or somewhere on the a restaurant here in North America, but that's very common in the bar. When you go in the bar and when you order some drink, they're asking you, are you paying or you want me to put it on the top?
Yes.
What that means to put it on the top?
It means that you
In a
still
pay
have
period.
to.
you'll pay later.
I'm gonna pay later.
After
So what
after
they gonna open
finishing
for me? Right. What they gonna open for me? They're gonna open for me account.
Yeah.
And in that account, they're gonna start accumulating. And when they say, I want to settle, I want to close my tab, what do I want to close? I want to pay my accounts payable. Make sense?
Yes.
Okay. Same idea with the on account when you purchase something on account. Let's see the next transaction. So next transaction, what's happened? We actually start selling to the customers. We sold to the customer some of our products. The sale is for $34,000. The client pays us $21,000 cash.
Mm-hmm.
The balance went on the client's account. And those, whatever we sell to the client, actually cost us $17,000. So let's go and do it. So first, let's go with the simple thing. What we just did, we sold something, right?
Something,
Yes.
yeah.
Right. Before we do that, let's split this one because we need two transactions, right? So let's
Yes.
insert one line here and first one label it A 8A and 8B. So let's do the sell. That's easy. what will be the sale? That will be revenue for us, correct?
That's correct.
Yes.
Finally, we're getting revenue. And that revenue is going to go up with $34,000.
34,000.
There will be no expenses here, no dividends, nothing like that. No common shares, nothing. Nothing on the liability side. So where are we going to go? What we get?
We got cash of 21,000.
$21,000 cash, but we are short. You see here, we're short 13,000. We are off balance $13,000.
So it's accounts payable 13,000.
So who have to pay it?
That
We
is
or the
from
client,
account receivable.
Sorry, it's accounts
account receivable.
receivable.
right?
Yeah, accounts receivable.
Right. In general, if you look at the big picture, yes, it's accounts payable, but for whom? For us or for the client?
The client.
For the client. So
client.
that means for us is
Will
accounts
receive.
receivable, right? Which is better for us, right? This is always good for us. And once we put those 13,000 in accounts receivable, we in balance right away.
Yes.
Now, we're generating the revenue. But what we sold to the client, we sold him a product,
Yes.
correct? From where did we get those products? Did we
It's
found
part
it?
of the share.
Did
Is
we
it not
found
part
it?
of-
Did
Oh,
we found it? So listen to it. Did we found it on the street? You
That's-
just sold it?
That's our expenses. Right?
No, think about it. Definitely will be expenses. The question is from where did we get it? Did we found it
So-
on the street?
No.
No, from the inventory. So if we sell those one, do we have it in our inventory?
No,
No. Do we have to reduce our inventory?
absolutely.
Yeah.
Minus 17,000.
Minus $17,000. Now the inventory is going to go down. And that is going to go where? To expense. My expenses now is going to go up with $17,000. At this point, right at this point, do I know how much income I generate on this sale?
Revenue minus expenses.
So how much I get?
17.
$17,000.
Yes.
That's why we need, so that's why remember, every time when there's a sale of the items or services, there always will be revenue for the sale and always will be the cost related to that particular sale. If you're selling inventory, you have to reduce your inventory because you don't have the item that you just sold. And that inventory, the cost of the inventory is going to increase the cost of the goods sold, which is expense. And then you can see the revenue minus cost of goods sold. And you can see your profit right there. Do you want to know your profit every time when you do sell?
Yes.
Yes. That's going to help you, right? Otherwise you don't want to wait to the end of the month to figure out that, hey, I'm selling for 34, but my cost for the sell it is $35,000. Right? That will be too late. There's nothing you can do. But if you know that cost me $17,000, then I can easily, if I sell it for $34,000, I can easily calculate that I'm generating $17,000 income right there. Okay, let's do another one. Just keep in mind, every time when you have sales, 2 transactions. One for the revenue and increase in assets, either cash, either accounts receivables, and the other one to show the expense related to that sale, cost of goods sold, and decrease in the inventory. Let's go with another one now. So here, again, asset cash increase, accounts receivable increase, revenue increasing, which is going to help our retained earnings. And then we have to show for the cost of the goods sold. We're going to decrease the inventory and the retained earnings, cost of goods sold, is going to go up. That will decrease the retained earnings. Next transaction. Now the customer pay us for the sale on account. Let's see how we're going to do this. First question, what did we get?
11,000 cash.
11,000. Let's get the cash first. Every time when you, listen, when you smell that cash coming in, just get the cash. Record the cash right away. Then figure out what to do. Okay, I get the cash. Why did I get the cash? Did I sell new things to the customer?
No.
No,
No.
he paid his account.
He pays his account. So what do you have to do?
Accounts
It's
Abi.
A receivable,
accounts
what? Receivable.
minus.
Minus, right?
Mhm.
You're not gonna add it $11,000 more to his account. Because if I add $11,000, his balance gonna be 24.
Right.
Now, how much more he has to pay me?
2,000.
2,000.
2,000 more. Is there anything else involved here?
No, it's in
No.
balance.
We're in balance, so nothing else is involved. So let's get those one, and we're done. Let's do another one. Next one. Now the company make payment to the supplier for the inventory that we purchase on account. Remember, we purchased this inventory, we get the inventory, but we never pay for it. Now let's pay those people for the inventory that we bought. Let's pay them some money.
With minus cash.
Minus cash, how much?
13,500.
Minus 13,500. Where will be
accounts-
that effect? What we're going to reduce now?
Accounts payable
Accounts payable. With the same amount, right?
with the same amount.
Minus 13,500. So what's happened in this case? Our cash going down,
Yes,
But-
but so is
but
our debt,
accounts
our
payable-
liabilities.
but our accounts liability also goes down. Make sense?
Yes.
And we're in balance. Do we still have to pay for this purchase?
We
Yes.
have some
9,500.
How much we have to pay?
9,500.
$9,500. All right, let's keep going. Next transaction. Now, we're close to the end of the month. During the month, we use electricity. Now, BC Hydro says, pay me for the electricity, for all the utility that you pay, that you use. So let's pay them. What can we do? Otherwise, they're gonna cut our electricity. Let's pay for the electricity.
Cash.
What are we gonna do first?
minus cash.
Cash.
of
Minus
1,000.
cash 1,900.
And expenses.
Expenses
Minus-
now. Cash going down, expenses going up.
Yeah.
If the expenses going up, what's going down?
Return.
Retained earnings. Yes, exactly.
Ret-
Retained earnings
yeah,
goes.
return on. Yeah.
Retained earnings going down.
Yeah.
If the retained earnings goes down, shareholders' equity goes
Shareholder
down.
equity. Yeah.
Make sense? Okay, excellent. Let's do another one. Company paid advertising cost for the month for the amount of $2,200. How this is gonna be different than the utilities? Is it gonna be different or gonna be exactly the same?
It's
It's the
the
same.
same. It's just the same.
Same.
Just the amount will be different, right?
Yeah, yeah.
Minus 2,200. No dividends. Let's do another one. In the next one, let's pay our employees. They work for us. We have to pay them. How are we going to pay them?
We from
With cash, right?
cash,
So what's happened now?
Cash goes down again by
Cash
2.
going down again.
and the
2,000
expenses.
go up, right?
Yeah.
And we're done. We're in balance. Everything is good. Next one. Not much left. There are only 4 left. Let's see what's the next one. Now the owners wants dividend.
Yep.
Okay, let's give him a dividend. If we give him dividend, we have to pay him cash.
Yes, cash.
Minus 400.
Minus 400. And what we're gonna decrease now?
We dividend.
Sorry?
We are giving dividend.
Dividends.
So the dividend minus 400.
400.
What's gonna happen now? Retainer is gonna go down
Yes.
and shareholders equity goes down.
That's correct.
All right, let's do another one. My God, you're so good at this. So, it's the end of the month. All right. Usually at the end of the month, some things happens. Let's see what happened. Let's see what happened in the month. First thing is this depreciation. Let's go back to the Excel spreadsheet. So depreciation, I'm gonna explain again next time in the class, and we're gonna talk about this depreciation. If you want to watch the recording for chapter 3 for the second week, I can't remember which chapter it is. Watch the recording. There's an explanation for the depreciation, but let's see now how to calculate this depreciation. Here it's given 850, but let's come to the point. So depreciation it's related to the long-term assets, which is equipment, right?
65.
Right? In transaction 4, we purchase this
Equipment.
Let's put it on the new Excel spreadsheet, new worksheet, and I'm gonna put it here. Let's make it a little bit bigger, and let's start working here. So, first thing first. In order to determine how much to depreciate, we have to see how much is the cost.
Correct.
Right? Then we have to see, are we gonna get some cash at the end of the life of the equipment? In this case, they say yes. So we're gonna get cash. We can sell the equipment at cash of $3,800. So our cost for the equipment, we pay 65,000.
Yes.
And we can get cash once we sell it, 3,800. So how much we have to depreciate?
61,200.
65 minus 3,800. That's how much we have to depreciate. Now the next question is, how long we gonna use this asset, this equipment? And they're saying we're gonna use the equipment 6 years. 6. So every year we have to show depreciation expense year after year. So how much will be how we have to depreciate per year?
Cost minus
Depreciable amount, the amount that we have to depreciate divided by
By
the
6.
years that I
6.
have to
Yes.
depreciate. So every year we have to depreciate $10,200.
So into 6.
So times 6 is going to give us this amount, correct? But the year has, what's the interesting with the year? Year has months.
Divided by 12.
So we have
Then
January, we have February, and keep going all the way to December. So we went at the end of the December, how much will be my total depreciation? Has to be
0.
10,000. No, 10,200.
Yeah, 10,200.
10,200.
So every month I have to plug here something. How much I have to plug in January in order to have total 10,200?
Divide. So
850.
divide by 12.
This
Divide by
one
12.
divided by 12.
12. Yeah.
So if I put 850 here and all the way to the bottom, at the end of the year, my total depreciation is going to be,
10,200.
let's see if that's the case. $10,200. So we are now end of January. How much will be our depreciation at the end of January?
850.
$850.
850.
Make sense?
Correct?
Yes.
Okay, let's go and now do this depreciation. What we're going to increase? Expense
Expenses.
minus 250. What we're going to reduce?
Cash.
Do we have to pay?
Sorry. No, we don't have to pay.
Equipment.
Right?
Oh, sorry, equipment.
Equipment. So what's going to happen now with our equipment? Let's go here. Let's go back to this one. So after 1 year, once we depreciate 10,200, correct?
Mm-hmm.
What should be the value of my equipment?
It will be 65
That will
less
be that
850.
will be the depreciation expense. Let's do the same thing with the equipment. That will be our equipment. Now, how much we have to depreciate? First year,
850 a month. Per
10,000.
year, 10,200.
200. That's how much we have to depreciate. How are we going to depreciate it? Every year, 850, right?
Mm-hmm.
Every month, 250. So what's my value of the equipment? My original cost was 65,000, right?
Mhm.
That's how much I pay for the equipment. So how much will be my value in January? After I deduct my
Minus 850.
minus 850. And then keep gonna go. And what will be my value of the equipment after the year 1?
54,800.
54,800. Make sense?
Correct?
That will be year 1. Next time we're gonna talk more about it, and you're gonna see how much will be the value at year 6
At the end of after 6 years.
in December. How much do you think the value will be?
Zero.
It will be the cash value that's left. You have
That should be the value.
1,800.
Make sense?
Sorry, yes.
No, don't. That's a very good. At this point, I don't expect you to know. Don't get me wrong. I'm now going away above that we have to be. So don't worry. But that's the logical thing. At the end of the year 6,
Mm-hmm.
in December, we have to
Yeah, because
have
the
this
value we are
value.
getting.
Right. And then we can sell it and the value is going to be 0.
Yeah.
But we're gonna talk again next time about this. So what right now I want you to understand that we're gonna increase the expenses and we're gonna deduct the value, reduce the value of the equipment with the same amount. And now the value of the equipment is gonna go down minus 850. It's gonna be 64 and 150. Is it the same that we're looking for? Yes, it
Yes.
is. All right. Let's put the zeros everywhere. And let's go to the next transaction. Any questions with the depreciation thing? Do you understand that every time when we use the assets during the course of our operations, we have to show depreciation. And depreciation has to be equal to the proportional amount based on the year or based on the month of the usage. Make sense?
Yes, it does.
Okay, excellent. Let's go to the next one then. Do you remember we did the prepaid expense? We pay for the insurance.
Yes.
And what we said when we did that insurance?
When
We'll
we
pay
consume it
after,
at the end of the
yeah,
month,
after
we
using.
would.
After the year. So let's go with now with that insurance and let's see how much was the insurance. That was on transaction number 5. Let's copy it. Let's open new worksheet and let's post it here. Now, how much was the value of the insurance?
1,800.
It's 1,800. What's the period? 1,800.
1
Over
year.
12 months.
Over
Yeah.
12 months. Or 1 year. Annual. Right? That's our annual insurance. What means annual? That we're gonna have
Divided
January, we're gonna have
February till
February, and
till
keep going
December.
until December. Let's do
Yeah.
that. So at the end of December, how much should be my insurance value of my insurance?
0.
0. That means I use it, correct?
You've used
Yeah.
it.
I
Yes,
use the entire insurance,
correct.
right? So we're gonna have this insurance per month,
150.
and then we're gonna
Hun-
have total.
Total. Yeah.
Total has to go down to 0. So the per month the total should goes to 1,800, and in
Yeah.
total should go to 0. Correct? Because that will be my expenses. Let's put one thing. That will be my expense. And then that will be my asset, which is prepaid expense total. Make sense?
Yes, it does.
Yes.
Okay. So per month, how are we going to calculate per month?
Divided by 12.
This one divided by 12.
Well,
Let's do this calculation here. Annual per month. That will be this amount divided by 12. So every month we have to transfer here 1,500, right? And let's do it. Once I do that, my total here will be 1,800. How much will be my balance
0.
of the insurance at the
At the
end of
end of
January?
At
It's
the
gonna
end,
be
the 1800 minus 150.
minus 150. Right?
150. Yeah. 1650 and then
Next month will be that one minus 150, and every month is gonna go down with 150 until it goes to 0.
0.
Make sense? So now for the month of January, this will be my expense. This will be that should be my balance for the prepaid expense. prepaid insurance. Correct?
Yes.
Okay. So let's do that transaction then. Let's go down and show expense 150. And what we have to reduce now?
Prepaid insurance by
Prepaid
minus 150.
150. And we're done. Nothing else changes. What's the last thing that left? Let's see what's the last thing that left. We're done with the insurance. We calculated, we figured out 650, we increase the expenses, we decrease the last thing that left is the
Accrued expense.
that will be the interest. Which interest is that? Let's go and check what's happened with the bank loan.
Yeah, the loan we
Let's copy this and let's move it to the new
One.
worksheet. Not that way, I want it this way. So on that day, that's what's happened, and let's cut this one. Now the question is, watch this. The question here is this. Let's do some calculations. How much is the bank loan?
100,000.
$100,000. That probably is a million. I put too many zeros. Let's get rid of 1 zero. What's the interest?
6%.
6% is what? What's the period of the interest?
12
Annual.
months. Annual.
Annual. What that means? That's every
We have
all
to
the
divide for
entire
every month. Yeah.
So no, the first is for the entire year. Now, how much is my interest for the entire year? Total interest
6% of
the rest
100,000.
per year.
So, two,
I can see your screen.
This one times 6%, right? 6,000 is my total interest per year.
Yes.
Correct?
Sorry, your
Yes.
screen is not shared at the moment. Would
yeah,
you
we
like
are
to
not
share?
able to.
Sorry
Let's
about
share
that.
it. Sorry. No.
Thank you.
That's a very, very good comment because I at some point I don't let's see this. How about now?
Not
So
yet?
500. Yeah, the
there we go.
500.
So our interest per year is 6,000.
That's correct.
Now the question is,
It's over 12
how much
months.
is per month?
So
5,000.
500.
0.5%.
That's
February,
500.
500.
right? So let's get the months. Interest and interest. So total per month will be this one divided by
12.
12,
12.
500. So every month we have to put 500 plus 500 and keep going until the end, right?
Yes.
Until we get the total of 6,000. And that will be our expense, correct?
That's correct.
Yes.
So that will be our interest expense.
Expenses.
Okay, we got the interest expense. Now, how often we pay the interest?
You're paying it monthly.
Per
Check.
6%.
Check here.
Oh, sorry. Every 3 months I read.
Every
Every
3
3
months.
months.
So when
five
is the
into
payment?
1,500.
So we have to
At
pay.
the last, yeah.
So we're gonna get this one plus
January,
this
February,
one
March.
plus this one.
March.
At the end of March, we're gonna pay this one. right?
Yeah.
Then, oops, not that one. Then end of June, another fee.
Yeah.
End of September, another one.
Like 4 times
End
a
of
year.
December, 4 times a year. Make sense? So now the
Correct.
question is, since we're not paying at the end of January, do we owe the bank money?
And we don't, at the, sorry, no, we have to,
We still
it's,
But it is
So-
an expense for the month.
So,
Will-
It's not.
so,
will
so
be
let's think about it. So let's think
interest
about it.
payable.
So let's think about it. Did we use the bank money for 1 month?
Yes.
Yes.
Mhm.
Do we owe them money for the fact that we use the money?
Yes.
Yes.
The fact that we don't have to pay now, it doesn't change the fact that we owe them money. Make sense?
That's
Yeah.
correct.
So do I have to show this expense in January?
Yes.
Yes, we need to.
Yes.
What will be that?
Yes.
Payable.
500.
Right? So let's go and record this one. First, we're gonna record the expense minus 500, and then we're gonna
That
show
interest payable.
interest payable of
500.
500.
Yeah.
And this case will be positive, right?
Yeah.
No assets, no assets, no assets, no assets, no assets. No accounts payable, no bank loan, no shareholders, and we're done, correct?
Yes.
So
So why
once
is-
we
why
come
is
to
it-
this point,
Hello.
yes,
Okay, I was asking why is the interest payable positive?
because increasing our liability,
Oh, okay.
Right.
Yeah, that's true.
right? Now I have to pay $500. If I put it negative, that means the bank has to pay me interest, which doesn't seem right, right?
It would be nice though.
Right? It's our liability, so it has to go up, right? So once we're done with this, what do we have to do? Start preparing the statements. What was the first statement? Income statement. What do we have on the income statement?
Um,
Income
Revenue?
expense. Revenue minus expenses.
And expenses. Do I know my revenue?
yes, we do.
Yes. Yes.
How much is it?
34,000.
34,000. Do I know my expenses?
Minus
Yeah.
26,000.
26,000.
26,000. Do I know my income?
Income is called our, we have to minus this.
How much our
So
income?
Revenue
revenue minus expenses.
So how much is it?
7,400.
7,400.
7,400. Can you see it?
Yes.
So we get the first number. We prepare the income statement. After prepare the income statement, what do we have to prepare? Statement of owner's equity, right?
Yes.
Yeah.
So let's get rid of this. We don't need this one. So what do I need for the owner's equity? I need the capital,
SS.
contributed capital, right? Owner's capital. And retained earnings. Once I get those two, I can see how much is the owner's equity. Correct?
Correct.
How much the owner's capital?
250,000.
250,000. Now, how much the retained earnings? Well, for that one, we need a separate calculation, right?
Yeah.
On the retained earnings, let's get this
Opening
retained earnings. And let's do the calculation for the retained earnings. Here. What do we need? We need beginning balance.
opening return. Yeah.
How much was it? First year of operation.
Not
No,
zero.
Zero.
zero
Zero
because it's
because there
new.
is
Zero.
nothing.
Nothing. There's
Another,
nothing.
yeah,
Right?
there's zero.
There's nothing. Then what we have to add? We have
Plus
to add
net income.
net income.
Um,
Let's add the net income. Do
and
we know the net
dividend.
income?
Yeah.
So,
Yes,
Yeah,
7,400.
7,400. 7,400.
We calculated 7,400.
that's
400.
And then
And
we
then
have to deduct less
deduct
dividend.
dividends.
Declare.
dividend. Do we know the
400.
dividend?
It's 400.
Yes, 400.
So how much is our retained earnings at the end?
7,000.
Retained earnings. Ending balance of the retained earnings is
7,000.
7,000.
7,000. So this number here is 7,000. So how much is the total owner's equity?
257,000.
Total is plus both.
Plus both and 257. Let's make it nice and neat like this. And that's our second statement, right?
Right.
What's the last thing that we have to prepare?
Cash flow.
Balance sheet.
Balance sheet.
What we're going to have on the balance sheet? We're going to have assets.
SS.
We're going to have liabilities. And somewhere here we're going to have equity.
Yeah.
And we have to make sure that we are in balance, correct?
Yes,
How many assets we have? Oh, those are our assets, correct?
Yeah.
that's correct.
So we have
Control C, and let's put it here. Let's paste the special values. Boom, boom. Those are our assets. Do I know how much my cash is?
Yes, we do.
yes,
So
113,200.
13,200.
accounts receivables,
2,000.
2,000. Inventory,
6,000.
6,000.
prepaid insurance,
1,650.
equipment,
64,150.
and land,
180,000.
180. How much are our total assets?
All
Don't
of
know
them.
yet.
All of them.
All of them together,
How much?
right? Let's get this one like this. All of them together. And that will be $367,000.
Okay.
Right? Now let's see our liabilities. How many liabilities we have? 3.
3.
Let's
Accounts
copy
payable,
it
interest payable.
and let's put it here. Paste special, values, and transpose. Boom. Have those. How much our accounts payable?
9,500.
9,500. Interest payable?
500.
500.
100.
Bank loan payable?
100,000.
100,000. In how much is in total? Let's get here
Total.
total liability.
110.
110,000.
10,000.
We get our liability. What else we need? Equity.
Equity.
But we already have it, right?
Yes,
Yeah.
we do.
257.
Total equity.
And the last thing that left is to calculate our total
Total.
liability and equity. And how much is that?
367,000.
Are you sure?
Yes.
So that means we're not in balance. Or we are in balance.
300. We are in balance.
I'm joking. Let's get rid of this. And let's get those two together. Boom. 367.
Yeah.
Just like magic. Why we unbalance people?
Because the assets
Assets equals
equals
to
the liabilities and
plus
equity.
equity.
Because on this chart, everywhere we in balance,
Yeah.
right? As long as you keep that one in balance, you always everywhere will be in balance. Make sense?
Yes.
Yeah.
That's your key here. Now the question for you is this. Once you have this, can you do your own accounting? That's what the question is.
You mean our personal accounting?
That's exactly what I mean.
Yes, we can.
Yeah.
Then what are you waiting for? That will be my only question. Make sense?
Yes.
What you have to do is, if you want to have more idea about the expenses, on the expenses here, extend this column and put the nature of the expenses.
Fresh.
Groceries, telephone bill, this. Revenue will be your money that you're getting from the
Money
employer,
income. Yeah.
right? Income. You don't have to invest in yourself, right? Not yet,
Yeah.
right? But you can start with the cash and you can start here how much
With
money you have in a bank account
bank
and start
account
running the calculations.
and the credit account. Interest payable.
Interest payable, if you have interest payable. If you don't have interest payable, you can eliminate it. Accounts payable can be payable for the credit card, payable for the
Yeah.
cell phone, payable for this,
The mortgage, the car.
mortgage, the car, everything. Or you can put here separate column. Small payables, which is telephone, internet, and this. Medium payable, which is mortgage, car, this. Big payable, car, so car and anything like a computer and anything that you have on like a medium kind of amount, and the big amount will be the mortgage. You can split it by those three categories, liabilities, and always monitor where I am. And once you run the total here, you're gonna see, okay, I'm generating 30, my income is 34, I'm spending 26, 7,400 left. Where they are? Oh, I have assets, I have liability. Okay, how much of those assets are mine? So you have 367 assets, right?
You check
But the question is, how much of those assets are mine? Only this much. Why only 257? Because I have liabilities. With those assets, once I pay my liabilities, that's my equity. At the end of the day, you want to know from the assets that I have, I can see I have assets, but how much of those assets are mine? Is all of them mine? No.
No.
Why? Because I have here liabilities.
Liabilities.
Yeah.
So what is mine? Only this part.
Cat.
Right? Make sense?
Yes.
So let's change the names of the worksheet. That will be the slides. That will be, first one will be the calculation of the
Depreciation.
equipment,
Yeah.
depreciation. Next one will be the insurance expense, expense. And the last one is the
Interest.
Expense. So I'm gonna save this one, and that will be slide solution. You are section 28. Save it. And the next thing that I'm gonna do is so that's how we're calculating the interest expense. Then we're preparing we already have the chart. And from that chart, we start doing the financial reports. Again, remember, first one that comes is the statement of income. We want to know how much income we're generating during the period. And what we're going to do, we're going to calculate the profit. We're going to see the expenses. So we made the short version, but we have to, if you have to do the long version, it's going to be sales to revenue, cost of goods sold, gross profit, expenses, 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 net income. After we do that, we want to see statement of the changes of equity. Means what's happened with the shareholders' equity. It starts with balance zero. Shareholder invested $250,000. The company generating $7,400 for the period. The dividend of $400 was declared and paid. So the total increase in the shareholders' equity for the period is $7,000. So what's the final balance for the shareholders? $257,000. Once we do that, we have to prepare our statement of financial position or the balance sheet, which is going to look like this. Okay, we're going to have assets. Now we're going to split the asset on the current asset and non-current asset. Current asset will be cash, accounts receivable, inventory, prepaid, insurance. Equipment and land will be non-current or long-term assets. We're going to see the total assets. And then we're going to start chasing what's the portion of the liability. We're going to split it on the current liability, non-current liability. So we're going to see accounts payable, interest payable, our current liability, non-current liability, $100,000. Shareholders' equity, we already know where it is. Common shares, 250, retained earnings, 7,000. Liability and equity is equal to the total assets. We in balance. Done. For the cash flow statement, if I have to teach you how to do the cash flow statement, we need at least 2 chapters, 4 meetings, 4 lectures. So for that reason, we're just gonna take it for granted. We're gonna see that operating activity, we're generating $8,600 cash. From the investing activities, we spent $450,000. From the financing activity, we borrowed $349,600. That's why our cash from zero moved to $113,200, which is our balance for our cash. The other thing that we can see right here is look at our current assets. We have 122,850 current assets. And our current liability is only $10,000. This company is very good state right now. So we can calculate our profit margin ratio. But on the ratios, we're gonna spend on week 3, we're gonna talk more about ratios, and I'm gonna explain more about the ratios. We can get the profit margin ratio. We can get the return on equity ratio. We can get return on assets ratio. Those are the ratios that we can get right away. And that will be the end of this chapter.